Hello and welcome. I am Suyash Maheshwari and you are watching Last Tick here on News 9. We bring to you the lowdown of the day's action on the Lal Street. Now, Indian markets extended their losing run to 2 sessions with the last tick for Nifty coming in just above the 21,500 mark. Today's price action pretty much signifies a departure from the previous bullish trend as the headliners closed very near to the day's low. Nifty ended down about 0.69% at 21,517 mark, which was just about 17 points above the day's low, which comes in at 21,500. Sensex, on the other hand, fell about 535 points. The index closed at around 71,356 mark. Now, the broader markets overall were mixed. Nifty Mid Cap 100 was up about 0.3% and it closed at around 46,529 mark, and this was the index because of which the overall breadth of the market was also favoring the bulls. We'll come to that in just a bit, but let's also look at the small cap index. It ended flat with a negative bias and it closed around the 15,188 mark. Volatility also slipped in today's session. India VIX which was closing in on the 16 mark just a few sessions back, has pretty much come down, and today it was down by about 3.3% and sits above the 14.1 level, so which is still historically elevated. Among sectoral indices, Nifty IT was the worst hit. The index was down about 2.5%, in fact over 2.5%, and so far in 2024, in the first 3 sessions of 2024, it has been the worst performing sector. Overall, it's down by about 3% or so. Other laggards in today's trade were metal stocks. They were down by somewhere around 1.8%, followed by Nifty Financial Services, which was down somewhere close to 0.42%, and Nifty Auto and Nifty Bank, which also ended today's trade in the red, down by about 0.12% or so. On the other side, PSU banks were the top gainers. The index surged over 1% in today's session, followed by the pharma pack, which was up 0.61%, and the media pack, which gained about 0.5% or so. And moving on, also the breadth of the market, now that is in the favor of the bulls. If you could pull up the numbers of the market statistics, you'd see 1400 stocks advanced in today's session, whereas only 1100 shares declined. 106 shares remain unchanged, and 204 stocks hit a fresh 52-week high, whereas 8 stocks declined to their 52-week lows. But with that, let's also bring on board Mr. Amit Gupta of Fintrekk Capital. Thank you for joining us here on News 9, sir. Now, the markets, they have not had the best of the starts to the new year. Nifty is down somewhere around 300 points or so in the first 3 sessions alone. Nifty Bank, now that has fallen by about 1,000 points. So, what's the overall view or the assessment of the market now? Should we be cautious, or should the strategy still be buy on dips?
Yeah, hi Suyash. Thank you for having me, and Happy New Year to you and the entire News 9 team. So I think we are just consolidating the gains of last year. There was a huge rally, more than 5% rally in the month of December. We ended around 21,700. And I believe we are just consolidating the gains which we were acquiring at the end of December. So there is a little bit of profit booking. There is a little bit of portfolio adjustments at the start of the year. Still, it's a very stock-specific kind of a market. So one needs to be cautious if they are in the overheated sectors or overheated portions of the markets. But otherwise, it's a very stock-specific kind of an environment, and where you need to follow your stocks, how they are delivering earnings, and take it accordingly.
All right, and IT stocks, now they have taken the worst beating in 2024 so far. In the first 3 sessions or so, the index is down by about 3%, in fact over 3%. What's leading to this sudden shift in sentiment? Because November and December were great for IT companies.
Yeah, I mean, I've said it before also. I was not in the camp where I saw the IT index or mostly the IT services companies going up.
Hmm.
I think if you remember, even in 2000, the companies used to grow 60, 70, 100%.
Hmm.
Now these IT services companies, top companies like Infosys, TCS, Wipro, etc., they are struggling to grow even at 8, 10%. The size have changed. The business have become more commoditized, and AI will actually worsen it even further.
Hmm.
So I think these are legacy businesses which are sort of rolling off. The new businesses, which is the digitization part of it, that is picking up. But on the balance, the guidance is about 1 to 3%, and there is a risk that even in this uh, earnings, which we are going to see in Q3 earnings, we will probably narrow it down to even 1%. So
Hmm.
my sense is that most of the IT services companies, especially in the Nifty IT index, a lot of these companies are basically now commoditized, mature in nature, and they haven't really reinvented. The larger opportunity lies in small cap and the mid cap space, which has done really well in 2023, and I expect that to
Hmm.
continue even in this year. I think the larger opportunity remains there, which are going to substantially leverage AI in the coming years.
All right. And moving on to the stocks or the group of stocks that are performing, the pharma pack. Now they have been and on a tremendous rally so far in 2024. Nifty Pharma Index is at all-time high, in fact, and a lot of these stocks, Amit, are also trading near their 52 weeks high. Now, in the pharma space itself, there are several different verticals, right? Hospitals, diagnostics, healthcare, to name a few. What do you prefer at this point in time, sir?
So I think, as you said, there are a lot of, verticals within the pharma space with a lot of subsectors. So something like, US generic-based pharma, that is not very exciting for us because there the negotiating power has totally shifted in the favor of buyers. The sellers are never going to make extraordinary profit over the next decade, so there could be like one odd opportunity in a complex molecule, etc. But otherwise, I don't see, big money being made there.
Hmm.
Having said that, there are small niche opportunities which are coming up, whether it is in CDMO space
Hmm.
or there are API based, fermentation based APIs. There, I think the opportunity size is smaller,
Hmm.
but at the same time, the negotiating power in the favor of seller is quite high. So you have to find those kind of profit pools which are much more sustainable and which can grow over a long period of time, whether it's in pharma or API based or even healthcare.
Hmm.
And accordingly pick stocks for me. So for me, the US generic is a sort of a no-no zone, but
Hmm.
API based pharma or a CDMO even is a good space to be in. At the same time, healthcare is picking up and expected to do well over the next decade in India. Valuations and a lot of the leading names are not so much in favor, but there are very niche opportunities, specialty hospitals which are coming up. There are a few IPOs also, in the pipeline for that. So we are evaluating that in that sense.
All right. And Amit, the December quarter earnings season is upon us. Anything different that you expect this time around that we did not see in the first two quarters of this financial year?
So I think one sector which I will be very keenly observing regarding the commentary, and that is the agrochemical and specialty chemical space.
Hmm.
Because according to me, the China dumping or the inventory destocking is still happening in a lot of companies. And I think the commentary will give us the idea whether we are at the end of that dumping cycle, or there is probably one more quarter, Q4 quarter pain still left in the company. In any case, we are sort of bullish from a 2 to 3 years perspective on these spaces, whether it is specialty or agrochemicals. So we are looking to either buy fresh opportunities or scale up the existing opportunities in this space. So I will be keenly observing the commentary coming out of the chemical space.
All right, and moving on to the big story today, which was the Adani verdict that came out. And first of all, I want to ask you, what did you make of the verdict that came out? Is it as clean a chit as one could have hoped for?
Yeah, I think it's pretty much a clean sheet. The important thing in the today's verdict was that there will be no further escalation to either CBI or SIT. The case remains with SEBI. Already SEBI in their October verdict last year have given a clean sheet in 22 of the matters out of 24. And two matters remains, which they again have given 3 months to resolve that. So my sense is that this is sort of a clean sheet, and this is quite positive for the Adani Group companies.
And Amit, Hindenburg in its report had claimed that the valuations of the company are sky high, and the group has pretty much made a turn around in the last 1 year. The balance sheet has improved. They are better capitalized. The leverage has also come down. They have restructured some of their other debt as well. So, are the 10 listed stocks still looking overvalued to you?
No, I think a lot of overvaluation has gone now. Stocks have corrected 60-70%. I think except probably Ambuja Cements, which is again back to new lifetime highs. Most of the stocks are still 30 to 60% down from the top which we saw last year when the Hindenburg report came. So I think also we have 2 billion of bond repayments which are due to mature across all the Adani Group companies. So after this verdict, there is a good chance that there will be a lot of global investors who will be in discussion for potential equity or debt infusion into a lot of these companies, especially something like Adani Ports or Adani Green Energy. And so my sense is that the overall the Adani Group will aggressively pursue growth. They will tap international markets. They will tap global bond markets to refinance their outstanding bonds. They're also likely to sell some promoter stake in group companies and raise funds so they can invest back into the emerging businesses. Already we have seen some reports which says that they want to apply for more airports. They are very aggressively pursuing green hydrogen plans, and along with that, they have they're opening 100 more centers in the data center space. So I think they do need the capital, and this clean sheet would sort of help them in raising the money and keep the boat rocking.
Right. So can we expect that the follow-on public offer, which was scrapped last time around for Adani Enterprises, could that finally come out this year?
Yeah, let's see. I think they'll probably wait for the final verdict from the SEBI, because if they apply for an FPO again, then again this ruling can come into hindrance. So my sense is that once they'll get the final check only, then they'll look for FPOs. There is also a small question of elections being there in April, May. So once these two things are done by, let's say, May and June, then we can see Adani Group moving aggressively on the FPO again.
But overall, would you say it's safe to say that the group is on a better footing now fundamentally than they were before this report came out?
Yeah, I would think so. Overvaluation is gone. There has been a considerable deleveraging. Now there is much more wider participation in the stock also. Quite a few global investors have already participated in it. The overall participation from the mutual funds in the top three, four companies have increased. Adani Enterprises is now part of the Nifty. They're looking to demerge a lot of the companies or spin off the companies. So I think one can say with a reasonable sort of certainty that worse is over. How fast it's going to move, that would depend, again on their fundraising plans and deliverables which they are going to do across verticals.
All right. And Amit, before we let you go, 7 out of the 10 group stocks are still below that pre-Hindenburg report sort of levels. Would you recommend taking positions in them, or would you still prefer the stocks that have been performing, like your Adani Power or your ports, which have given phenomenal returns, over the last year or so?
I mean, as a full disclosure, we have recommended few of the Adani stocks last month post the state elections. We do believe that there is a value in a lot of the space, especially the clean energy and the renewable space which the company operates in. So I would not like to make a specific sort of recommendation, but we do feel that a lot of these businesses are futuristic businesses, and if the company sort of stay deleveraged a little bit, they're able to make bond repayments on time, and at the same time they're able to implement the plans which they have sort of publicly shared with us, then there could be a significant upside over the next 2 to 3 years.
All right. And Amit, one final question for me, because there is a lot of uncertainty that's still in the market. And in fact, the market view has also kind of turned cautious. What will be some of the factors that you'll be, keeping a close eye on over the next, let's say, 1 month or so?
So I think the issue is that in the last 3 months there have been a lot of churn in the portfolios, whether it is investment advisors like us, or even the PMS industry or the mutual fund industry. There has been a lot of churn from the small cap and the mid cap space to the large cap space, in the hope that FIs would come back, and they are going to come back and actually buy the large caps. My sense is that this optimism has gone a little ahead, and if the FIs don't come back in the next 1 month or so, then there is a volatility event or a liquidity sucking event happens because of the global market. Then we can see a sort of very quick and sharp downturn into the markets. So if that happens, then I'll be a buyer on the dip. But at this point of time, I think the uh, opportunity to freshly deploy money is quite limited. In fact, we are slowly trimming some overweight positions over the last couple of weeks, and we are sort of wait and watch and see, how the companies deliver, and then take a call of increasing our positions from the cash. But at this point of time, we are happy to sit a little bit on cash, trim some of the positions, and then see how it goes. But the opinion that the market is going to crash, I think that has gone on to a little extreme, and the markets really correct when everybody expects it to correct.
All right. So just to clarify, would it, as you were pointing out, would it be prudent to hold some positions in cash right now instead of being all invested in equities?
Yeah, that's what we have recommended our clients, and that's what we have been doing in our strategies as well. We have been booking profits into some spaces which are overvalued, or like clean energy, like railways, like defense. We have been sort of trimming positions or even booking profits into that, and as a result, we have already raised cash. And if correction happens, then we will be happy to deploy into certain segments.
All right. That's the view coming in from Amit Gupta. Sir, always a pleasure talking to you. Thank you for joining us here on News 9.
Thanks, Suyash. Thank you for having me.